Good afternoon and welcome to today's webinar on picking apart the European property problem. My name is John Wilton. I'm a director here at the Global Institute of Credit Professionals, and we're lucky enough to be joined today by Mary Pollock. Mary.
Hi, it is great to be here. I'm a managing director at Credit Sites. For anyone who's less familiar with Credit Sites, we are an independent research provider and very much focused on buy-sell recommendations for specific bond issuers. So more, I would say, an investment perspective or a market perspective than my counterparts on the rating side who look to rate companies through the cycle. In terms of my background, I've been at Credit Sites for over 10 years. I have worked in our US and European offices, covering both US and European credits, up and down the credit spectrum. So everywhere from single A to triple C rated companies. And now I'm very focused on the European real estate sector.
Thank you, Mary. So to kick things off, can you give us an overview of where we are in this property cycle, and in particular, the overview of European real estate?
So to explain where we are today, we need to go back in time about 2 years to the brutal year that was 2022. European real estate is obviously a yielding asset class, and it was bid up in the low interest rate environment. And I think the valuations we reached end of 21, early 22 are now seen as frothy. And what happened in 2022 is there was this sudden change in expectations for inflation, for rates, and then that was not immediately reflected, obviously, in property valuations. I'm going to talk about property valuations a lot, and just to quickly flesh that out a little bit, that often means a valuation assigned by a CBRE or a JLL. It's a DCF model or based on comparisons. It's not where the property has changed hands today. So there is this lag effect with regards to the change in expectation and what are these properties actually worth. So 2 years later, where we are now, we have some insight into what this property cycle actually means. Valuations are down considerably. So for the companies I cover, on average, property portfolios on balance sheet are down by around 15%. But some valuers for certain subsectors and certain geographies have, even for prime properties, peak to trough valuations down 20 to 30%. So some of the pain has definitely been felt. Looking forward, I think general consensus is valuation troughs will be reached this year. There is a lot of focus on the transaction market. So what a valuer thinks a property is worth is theoretical. What we need to see is properties changing hands to have insight into where fair value is today. Transactions were down hugely last year. We expect valuations to be higher in 2024 than 2023. That's also what the valuers are expecting. But I would say the data out of 1Q definitely didn't reflect that yet. I mean, in some cases, transactions still as low as the GFC. So it remains to be seen. But that's kind of where we are, hoping the trough is in sight, and then property cycles span years. So the years to come of still some refinancing risk, potentially more defaults, sales for receivership, etc.
And just to drill a little bit deeper on that, how are dynamics differing by geographies, and which countries have been most impacted by this cycle? Which are you most concerned about?
So the two that definitely stand out for me are, in terms of regions, would be the Nordics and Germany, for different reasons. So focusing on the Nordics to begin with, the Nordic property companies structured their balance sheets very differently than issuers on the continent in the UK. They had more floating rate debt. They had more front-end loaded maturity profiles. So when across the sector, where's this question mark of how far valuation is going down, they had the added headwind of a sudden change in their interest costs because of that floating rate debt exposure. They also had refinancing needs for the tough years that were 2022, 2023 that needed to be dealt with then. So that compounding effect definitely has meant the Nordics are in the spotlight. It's also a region where those valuations were very much bid up. And then I think Germany, in particular German residential, is an interesting sort of poster child for this cycle in particular, because it's a hugely defensive asset class. There's a supply-demand imbalance, and because of that, yields were low. One anecdote I like to remind investors of is in 4Q22, there was a period where prime yields on residential properties in the top 7 German cities were below 10-year German bunds. So that really speaks to the dislocation going into this property cycle, which is so tied to the rates dynamic. Because their yields were so low, they were more impacted by this change in rates and what that means for cost of funding, as well as property valuation. So Germany's also, I would say, been the other market I'm most focused on.
What's your view on the cost of funding at the moment and the outlook for rates? Is it having a significant impact on the demand for commercial real estate?
So CreditSight's view is that we have 2 more rate cuts this year from the ECB. We've obviously just had our first. This is something that is a point of discussion a lot with clients and I think with the issuers themselves, because is it the rate cut itself or is it the expectation of the rate cut that should drive an improvement in transaction volumes? And I would argue we've had an expectation of rate cuts and consensus that we're past peak rates for over 6 months now, and we haven't seen those transaction volumes come back yet. So that's clearly only one variable. Now we've had 1 rate cut. It still doesn't look like it's going to be the catalyst. There's a lot of other variables that need to align for us to see that. So I would say, yes, uncertainty about rates is still impacting those transaction volumes. But as we move through this year, and I think the consensus around rates continues to solidify, hopefully that will be one important point of certainty, or at least from the buyer perspective that's raising new funding, they can be confident in for the outlook for their investment, where their cost of funding will be.
Understood. And I think this may come up in the audience questions later. And as a brief reminder, if you do have questions through the webinar, please feel free to submit them via the Q&A. But what about the outlook for issuers' credit metrics?
So in the last answer, I was just talking about a brand new property investment. So where you today can figure out all your deal math in terms of what the property's worth, what your cost of funding is, what your LTV, ICR, you can figure out what risk you want for what IRR. The issue with these companies is they undertook a huge amount of CRE acquisitions and they were acquiring each other. There was M&A activity in the run-up to 2022. So they were buying at peak valuations and funding with very low costs. They need to now survive with that balance sheet in a higher for longer world. I think the best way to think about which of those balance sheets are sustainable is actually less to focus on LTVs, leaving aside offices, which are a slightly different kettle of fish, and more to focus on ICRs. This will be a long-term headwind. When I model forward ICRs for the company I cover, I have those ratios deteriorating until 2028. So there is definitely more gradual erosion to come. That's important for cash flows, which has implications for investment, which has implications for dividends. But over time, the pace of that erosion will slow. So yeah, we're not through the worst of it in terms of metrics.
Yeah. And what about the property companies themselves? What have we seen in the primary market, and what do you expect from issuances from European real estate companies going forward?
Based on 4Q and 1Q results, I would go so far as to say management teams are cautiously optimistic, but I'm not sure if optimistic is the best word, because it may not give full credit to just how tough things were in 2023.
Yep.
So coming off a low base. But I do think there's consensus around transaction volumes picking up in the second half of the year. And for most subsectors, once again, leaving aside offices, that valuations will trough this year. The primary has also reopened to the sector. So the bond market was essentially shut to European real estate in 2023. Thankfully, year to date, we've seen issuance from defensive credits, from low BBB credits, and even, one debut high yield issuer, BFIMO. So a functioning primary, I think, allows everyone to feel some relief, both investors and the companies. This is particularly important looking forward because the bond maturity pillars for the sector in 25 and 26 are more than double what they were in 23 and 24. So we really needed this functioning bond market to handle all those maturities. That being said, the issuers will continue to look to the bank market, to asset sales, in some cases equity raises, to deal with refinancing needs. That's how they managed through 2023. We expect that to continue. So on a net basis, that would imply the supply will still be less than the bonds maturing for European real estate as a whole.
And switching the focus slightly, what's the equity market telling us about property valuations and the outlook for the sector?
So that's an interesting question. If you start taking a slightly bigger picture view, so equity declines on the major European real estate indices from year 821 as a somewhat proxy for peak values are still down by over a third. So they haven't recovered. And when you look at excess returns for European IG real estate, high yield, and carving out the hybrids over that time frame, for high yield and the hybrids, you also are still very much in negative territory, which I think you would expect when you think of those yieldier, more equity-light asset classes. In the year-to-date period, what's interesting is European real estate credit has outperformed. It's performed strongly. Excess returns are firmly in positive territory, but the equity market is soft. It's down by, I think, around 5-6%. Once again, those major equity indices. And I think why the credit market is now feeling more confident has to do with wanting to see through the cycle, realizing that even with that outlook for ICRs, like I talked about, there are a lot of issuers where agency ratings are intact. Mm-hmm. So worst case scenario for the sector is easier to put to the side, and spreads are already wide, so they outperform on carry. We've also had dispersion. So a lot of the issuers that we know are poorly positioned, they've seen multiple downgrades. SVB was downgraded from IG to high yield in a matter of months. We've had companies fall on the IG index into high yield. Those bonds are already wide, and so they also outperform on carry because that's some already priced in. Then on the equity side, equity investors are looking for growth. We've still seen this huge pullback in investment. Yep. That's a key growth driver for the sector. That doesn't look like it's going to restart in the short term. And then there's the dividend question. They want some cash out of these investments. It's not clear when that restarts. And I do think it's important on the debt side, investors to not sort of get too optimistic on what is good, as the equity market's still reminding us, equity cushions are hugely compressed from what they once were. And the future is definitely not all rosy for the real estate companies.
And how do dynamics differ by sector? Which sectors are the winners and the losers in terms of the current property cycle, if there are any winners?
So that's a good question, because a lot of this discussion up to now has been more focused on sort of cap rates, valuations, cost of funding. And that's really a question about fundamentals. When I look at the broader universe, I carve my coverage at least into sort of 4 big buckets: logistics, residential, retail, and offices. For most of them, in many cases, fundamentals are still very strong. And this is different than the GFC, where we saw that pullback, for example, in rental income growth. So it was the compounding effect of the financial issue and then the fundamental pressure. So where we're not seeing that, that's encouraging for buyers wanting to step back in to the space. Starting a little bit to dig down into those 4 pillars, logistics is the subsector we're most optimistic about. And I think that is broadly a consensus view. It benefits from the shift to e-commerce. In the short term, it is coming off some boom COVID years. Yep. So we will see some softening in terms of vacancy, sort of a return to normal. But what I hear from the companies I cover are still very strong releasing. And in certain urban submarkets, really strong supply-demand imbalances. So that lends itself to those companies that own the right portfolios. So most constructive on logistics, also cite higher cap rate than residential, which is another asset class where there's a lot to be positive about. Very defensive. Shelter is not discretionary. you also, in many European markets, have actually a supply-demand imbalance that is so pronounced, governments want more housing. I mean, we have that in this country. It's an issue in Sweden. It's an issue in Germany. But obviously, if you own housing stock, that puts more demand for your asset class. Rent regulation constrains growth, really importantly in Sweden and Germany.
Yep.
And that, when I was talking about German residential before, that is very much part of that dynamic, and has led to greater valuations declines as cap rates have expanded, because less of that is absorbed, if you will, on the rental growth side. So that tied to rates for residential will persist, the extent to which you still have concerns about the outlook for rates. And then there's retail. Retail really had its tough moment in 2020 when the shift away from bricks and mortar hit home because of the COVID pandemic. And that's when it saw valuations fall by over 20%, and they've continued to decline since. But interestingly, going into this crisis, cap rates were already wider. So it's sort of the opposite of that residential perspective. They were already better positioned from a cash flow perspective. Management teams were already playing defense. They had strong liquidity. So when the bond market froze, they were ready to deal with that. Their cash flow just tended to be stronger. ICRs were higher. So many of the retail players have fared relatively well, bearing in mind also early 2023, we still had some easy COVID comps to drive growth. And there's been a real dispersion across the real estate asset class. It's recognized now which properties are well positioned and will grow again, where you can comfortably underwrite growth. If you think about malls that are well kept up, sustainable, in central business areas, and those which are not. And that's as extreme as Unibail, which we cover last year, gave the bank the keys for a mall in San Francisco because the equity was underwater and they walked away. So that's an example of a property that faced obsolescence risk. But you've already had it play out. So investors can move forward. And that lastly leaves offices, which is interesting because it has the compounding effect of this cycle from the cost of funding perspective, as well as the, you could say, structural pressure or the change in the way we go to work, resulting in big questions about long-term demand. I actually think looking back at retail is an interesting proxy for how to think about offices going forward, because I think we could see a similar trend with a severe write-down and then years of plateauing or declining valuations, and most importantly, this dispersion piece. Different properties will end up facing this headwind in very different ways.
So let's look a little bit more closely at that. When we look at the office real estate market, how are different cities coping with return to work, and how is tenant demand for space evolving?
Europe is not the US. I think we should start there. Because I think some of the most worrying headlines about office properties have come from the US. And there we do see, when we look at some major US cities like San Francisco, LA, Boston, New York, the reentry levels to the office are much lower than we see from major European capitals, like in some cases down 40 to 50%, whereas Paris, Amsterdam, and Stockholm more like 15. So a different pattern of behavior. I would say London's somewhere in between. So London is definitely not immune. And then vacancy rates. And that also differs then at the micro level by some of these cities in particular. Where were vacancies? I think it's an interesting question because people often see this through the lens of where they work and how they live. But one reason that's held up that it's different in the US is longer commutes, more people use cars, and bigger accommodation. So they may have room for a home office versus if you think of someone in Paris who could walk to work but lives in a flat. So wants to get out of the flat every day to go to work. Those are reasons that are held up. I think one theme that cuts across from what I hear from my issuers in terms of that own office property is tenants want smaller, higher quality space. So in general, people are not abandoning offices, but they do need less square footage. So it's paring back, and then also willing to spend the same or slightly more for the right office. And what that means is higher quality, modernized. It means sustainable.
Yep.
And in some cases, it does mean more areas to work as a team, but that differs somewhat by industry. So that goes once again to that micro level of what is the property, and looking forward, what does this mean for properties and portfolios? It's not going to be the same for all. And when I look at, say, Jacina, which has a very attractive portfolio of properties in Central Paris, I can see them doing very well. Most of those properties, and I would say their KPIs have held up strongly. Whereas at the other end of the spectrum, there is some risk of obsolescence risk.
Focusing specifically on one word you mentioned there, I'd like to look at sustainability. So what are the key concerns for the real estate market at present within sustainability?
Sustainability is paramount for European real estate. And it's driving investment decision, it's driving tenant demand, and it's driving valuations. There are a number of considerations companies need to take into account when they think about how to deploy CapEx. But clearly, the regulation is going the way of more sustainable properties. The EC has targets for carbon neutral, which include targets for the real estate sector in particular. So in our view, any company that's not doing what they can today is making a long-term strategic misstep. Often there's a question around that dynamic which has to do with timing. So if you take for granted the direction of travel is all properties are going to have to be more energy efficient long-term, it's when is that implemented? And actually that question, interestingly, over the last 2 years, if anything, it looks like timelines have been pushed back a bit. And I think that's a reflection of the sector being under pressure, the public sector knowing it needs to work with the private sector, and construction just became a lot more expensive. So some recognition of that. So in that sense, the short-term nature of it, if anything, has relaxed a little bit, but it hasn't gone away. And as you know, in credit, we're all about risk. So this risk of a major CapEx requirement across many of these properties persists. We know it's impacting tenant demand, especially on the B2B side. So, logistics, retail, offices, tenants want sustainable properties. And then lastly, valuations. Buyers who are looking at properties, if there's a property that needs considerable CapEx to make it energy efficient, that's reflected in valuations today, or buyers are not interested.
Yeah.
So it is absolutely important for the sector.
So if we now switch the focus a little bit and look at the S and the G of ESG, which of those are a focus for the sector?
So governance, I spend a lot of time talking about governance, worrying about governance. And governance can be, in some ways, difficult to talk about. And I'll explain what I mean, because you sort of have your known unknowns or your known red flags. For example, I have numerous companies that have a founder who's also a controlling shareholder or a larger shareholder, sometimes with a dual share class structure, who also will be in management or sit on the board. Some of those companies also have levered holdcos that sit above them where that owner also owns or controls it. And you can see how that would impact their decision making with regards to something like dividends. Then we have, I would say, a more frequent use of related party transactions than I'm used to. And that somewhat has to do with development being a higher risk business. So if, say, that controlling shareholder owns 50% of a developer and wants to do deals with its property company, not necessarily a bad thing, but related party transactions always, it's on your radar. Then I would argue that there's poor disclosure on capital structures. I don't have fulsome capital structures for all the loans, what collateral is secured against them, even when they mature, or what their financing rates are. So all I would say red flags. And then also in real estate, you have your unknown unknowns. And for the companies where nothing has blown up yet, you don't know what those are, but you have had really high profile implosions. The short sellers have had an absolute field day in European real estate over the last couple of years. Viceroy obviously attacked Adler. It resulted in Adler filing for bankruptcy. It's not exactly, that made it sound slightly more linear than it is. But SBB was a target for a short seller. They've targeted Vivian. Now they've targeted CPI Property Group. And then we also have a number of regulators investigating those companies for different allegations. There's also an allegation going on for Heimstaden Bostad's minority shareholders in Sweden. So it's definitely worrying, the volume of anecdotes. And then I was saying like the known red flags that I see in the European real estate sector. So much so that I often say to investors that if you're not looking at your defensive names, which is like your French REITs, large equity floats, high agency ratings, you need to accept that there will be governance risk, and hopefully you can find a spread premium that you're happy to accept for that risk, which is a hard thing for people to swallow because you don't know how it's going to play out. And some just say no. I would say some investors really say governance is key to our investment committees, and if we're not comfortable, we're not going to be involved. But it is very important.
I think that brings us to the end of the first part of the webinar. We do have some questions coming in already, so I'm going to start addressing those. But if you do have any more, please feel free to send them through using the Q&A functionality. So the first one of these we have is, what is the tone of your recent discussions with investors like? How are your clients feeling about the sector looking forward?
So I think on the fundamental side, there is a more constructive take, sort of similar to what I was saying with regards to the issuers themselves, like a cautious optimism that a lot of pain on the valuation side has been endured, and an understanding of the outlook for ICR ratios, but feeling like they should be able to price that, especially for more defensive credits. That being said, given the rally we've seen in spreads over the last 12 months, I'm getting asked a lot, what's overbought here? You know, where are we too optimistic? Where are we over our skis? Because things are not as rosy as now the bond markets are pricing in.
We've got another one here, which is, what's your view of Canary Wharf Group? And is it similar to La Défense in Paris?
We are cautious on Canary Wharf Group. So when I was talking about work from home dynamics by city, I mentioned London being more like the US, and that's true in a number of KPIs. For Canary Wharf in particular, vacancies are high. They're already, approaching 20%. So, and it's also already cheaper than the West End in the city. It's a supply-demand problem. And it does not have the location. I mean, we were talking about what tenants want. It is location, an upgraded building, and sustainability. And so it's hard to see when that will reverse, given, like I was saying before, it's going to take years for office demand to reach a new equilibrium. We also have seen some extreme changes in valuations. There was one building that was just sold from receivership at a 60% discount to where it was acquired in 2017. So there's a lot of pain on that valuation side. And, I was talking about ICRs a lot before about how I'm focused on that with the caveat. I would still definitely look at LTVs for offices, because when you have that huge change in valuations, you also have to think about, okay, is this underwater? Or how high is your LTV? Does the balance sheet just need equity? And the Canary Wharf sponsors injected some equity at the end of last year, so clearly they recognized that was the case. But I think it wasn't enough looking for that group as a whole. And then we have some individual secured loans that will need to be refinanced as well, which will require equity. And then La Défense, I know it less well, I will admit. Icade and Gecina both have some properties there. I would say Gecina's has also benefited from some large leases signed, which you could say is constructive. And I know Icade has argued that the transport is strong, but clearly some of those same issues of not being centrally located are very much the same, and there will be more pressure on those valuations than in central Paris.
We've got one more. What is your most frequently asked question by investors?
In terms of subsectors, I definitely spend the most time talking about offices. In terms of credits, I probably at the moment, Heimstaden Bostad, SBB, And then, Grand City issued a bond this week. So I had a lot of conversations about Grand City and around town. And then often people want to check in on the sector as a whole, kind of, because we monitor such a large universe of names. Like, what is the overall view on some of these trends versus focusing on, say, just Canary Wharf, which has this really has some very big issues to contend with, or if they're looking at, say, just Unibail, which is diversified retail. So yeah, and it's sort of a mix.
We have one which is, what's your view on international workplace group and the flex workplace market?
So I don't cover international workplace group, unfortunately, so I can't comment on that. The flex work market is definitely growing. So Canary Wharf has launched Made For. Justina is testing it in their portfolio. Around Town is testing it in their portfolio. Bafimo has a huge hybrid work business. So, serviced office business. It is definitely increasing. I worry about it a little bit from my perspective as an analyst, because if you think about the property owner can then say, if they didn't sign a lease with a new tenant, which may have been their preferred plan A, they build it out as a serviced office with a promise that, this is going to meet the demand from the tenant who needs more flexibility and will be able to charge higher prices. But also it'll take 3 years before we'll know for sure if this is working out. It seems to me a way for them to potentially keep their occupancy up with a hopeful business plan, which still feels a little untested. So definitely, I'm monitoring it closely, and I would say at this point a little cautious that it will be the right strategy for all the companies I cover.
Yeah, excellent, thank you. And thank you to the audience there. We just managed to squeeze that last one in. So on behalf of the Global Institute of Credit Professionals, I'd like to thank everybody here today for making the time to join us. If you'd like to head to gicp.org, you can see our future events. And once again, thank you for joining us.